Welcome to the CU 2.0 podcast.
Hi, and welcome to the CU 2.0 podcast with big new ideas about credit unions and conversations about innovative technology with credit union and fintech leaders. This podcast is brought to you by Quillo, the real-time loan syndication network for credit unions, and by your host, longtime credit union and financial technology journalist Robert McGarvey. And now, the CU 2.0 podcast with Robert McGarvey.
Do you want to talk about bad debts and collections and what's that? You'd rather discuss athlete's foot and gyms? Listen up. On the show today is Gwyneth Borden, founder and CEO of Remynt, a debt collection QZO funded by One Washington Financial, the investment arm of Washington State Employees Credit Union, and a recent guest on the show along with Starlight, an innovative fintech that also won funding from One Washington Financial. There's a link in the show notes to that episode. So yes, Remynt is doing collections, but with a dramatic twist. It also emphasizes its mission is financial wellness, and it helps consumers pay off their debts and rebuild credit. That's a whole new twist to debt collection. Rebuild credit. Face it, a lot of Americans are struggling to pay their bills. Pew Research estimates that a quarter to a third of us struggle to pay their bills every month. Remynt is there to help while also helping credit unions collect the money they are owed. If that seems paradoxical, indeed it is. It certainly would be to many debt collector minds. Listen up as Gwyneth Borden explains Remynt's approach to debt collection today. So why did you write that piece for CU Insight about reducing the number of credit union mergers?
So here's the thing. So we are QSO. Remynt is a QSO. We are an outsourced debt collection solution focused on financial wellness. Right now, obviously, delinquencies are quite high. So many credit unions that are very small. Sometimes the actual CEO is doing collections calls, right? Which, if you have 6 people working in your credit union, it doesn't seem like a great use of the CEO's time calling people. But at the same time, you can't not reach out to people if they're in collections. And so I've been to a lot of smaller credit union forums, the concerns about mergers and who's going to be on what side of things, no matter the conference, whether it's a collections conference or just a general kind of league sort of conference. The issue around mergers, who gets merged, who gets served after that merger, the whole idea of these core communities and constituencies that specific credit unions serve that will be lost or may not be as well served through mergers. And then what that also means in terms of, do they have branches in those areas, or do they maintain the branches that those credit unions have? There's so many complexities to that. And you're seeing it a lot where increasingly the number of small credit unions is going away. Even the number of even a little bit larger than small credit unions are going away. Obviously on the other side, the community banks who already hate credit unions because of the tax exemption are wondering what makes, if you're making mega credit unions, is it still serving the same mission? I don't think that it's bad to have large credit unions. So I'm not saying that at all. And I'm not saying that larger credit unions serve the mission worse. I don't think so. But I do think that there are communities and constituencies that credit unions have served historically, that there is a benefit to having an affinity or association with a credit union that speaks to that community. And I believe that the challenge often is that not only is there enough staffing, but succession planning is also very tough. I actually went to a conference, a pre-conference before Money 2020, and they were announcing something called CUS. It was CU collisions, this whole idea around helping people get operational assistance for outsourcing kind of executive professionals, because the number one challenge in a lot of small credit unions is there's no succession planning, because there aren't a whole lot of people who necessarily make sense to transition into those roles, and 2, because of the size of the credit unions or the overall, say, maybe compensation, it's not like other people might move from other areas and want to take on those roles. So sometimes smaller credit unions are merging with others just because there's not someone to succeed the previous person. And lots of people, and younger generations especially, don't want a job where they're doing 5 million things, right? They want a more streamlined position. So I firmly believe that this desire to do everything is part of the challenge that a lot of smaller credit unions are suffering some from. And if they could really just focus in their energies on the areas where they really deliver value to the membership and building community, really being there and touching on the issues that matter in that community, making sure that they offer the core services that members expect is really what you'd like to have staff doing. And then, outsourcing those things, like you're not going to design your own core. So obviously you would get that from somewhere else. And collections is actually one of those kinds of spaces where the process can often break the bond between the member and the credit union, particularly at a later stage delinquency. There's a lot of fear and shame and embarrassment that people have, which is why they're avoiding your calls. If their credit union actually knows them, on the one hand, it's good because they have a relationship. On the other hand, it's more embarrassing when you're having a tougher time. So there is some benefit to having someone else outside doing it, or doing it in a way that supports your members. So I'm very bullish on the opportunity for credit unions, especially smaller ones, to better leverage outsourcing areas that don't make sense. And then sort of like everyone's doing with AI, so to speak, right? Like in the tech world, everyone's talking about, oh, you only need 5 staff people, and then you can basically have an AI assistant and all that sort of stuff. And even these companies that are well funded are still looking for efficiencies by using AI in that regard. Obviously, credit unions have a little different, steeper hill to climb on something like that because of the lack of technological support, or even sometimes even any sort of tech support that's in-house. A lot of time is out of house tech support paid for by the hour that is not dedicated to their resources. So having to train staff on new technologies, even on some of these digital products that they want to add to their stack, it's tough. And talking to smaller credit unions, I've seen lots of things from people investing in technology to do it in-house, but then no one really learning it or paying for something they don't actually ever use. And so that's why, I'm such a big fan of outsourcing, because I think we all have ambitions to use things that we bring inside, but the reality of actually executing on that is often hard.
When did your company become a CUSO?
We became a CUSO last May. So we are partnered with WSEU, One Washington Financial, out of Washington State. We're really excited to be working with them. They've also been kind of more aggressively looking at how they can better support earlier stage fintechs and bring innovation to their credit union, as well as this being part of a larger network of credit unions that are looking to really help advance the credit union industry through bringing in fintechs.
I did a podcast with them sometime in the last couple of months, and because they made an investment in a company called Starlight, which
Yep, I love Shri.
I've known Starlight since it was founded, basically.
Oh, that's great. Now, Shri and I share 2 or 3 investors. I can't remember how many of it's.
I'm talking with Scott Dawkins in a week or so about
Oh,
another company. So,
and Scott is great.
and yeah, he's making some investments in very early stage companies. CUSOs in general are not as early stage as some of the ones he's been putting money at.
Including mine.
But,
No, you're right.
but One Washington Financial has a pretty good success rate with its CUSO. So, and they're investing in things really designed to help people rather than something that's going to save every credit union 1% on their paper costs or something like that. I'm just making it. A lot of CUSOs historically, a lot of CUSOs did fairly mundane but useful stuff.
Right.
Whereas you got things like Starlight that are doing things that are much edgier and more useful in my mind.
Yeah, no, what we're doing collections, but ours is a focus on financial wellness, right? So members can actually rebuild their credit, access personal financial management tools, and even a community and a financial therapist through that community. Because when people fall behind, it's not simply that people are irresponsible or they don't know that they have debt. It's typically something has happened in their life. Maybe it's a cut of hours, loss of job.
Hey,
health.
it's divorce or
Yeah.
it's a medical crisis. These
Yeah.
are the 2 biggest triggers of massive debt.
Correct.
And in neither case is the person sitting there saying, "Hey, I want to be a deadbeat. It's really what I enjoy in life, just screwing people, ripping." Well, no, it's that hit a real roadblock in their life, and stuff happened.
And unfortunately our system's not really well designed for that, right? I mean, traditional collections is I need you to pay something right now, right? And typically what we see is that when someone has one debt in arrears, they have often multiple debt in arrears. In fact, one of our credit union customers, we see that some of their members have as many as four debts in arrears just with that credit union. So that person is trying to navigate all of their debts and arrears as well as living in their day-to-day expenses, right? And so that's really challenging. And I think that, the traditional approach of collections, which has been, the call center, calling people, social pressure, is it's less effective and it's not working as much, right? I mean, I think it's Akuvo, which is a bigger player. They're an in-house solution that includes collections as a CRM. You probably may have interviewed them, and they are a QSO, and they have a number of investors in the industry, and they even got some major private equity funding. But they're by their own numbers, I think they often say that there was 13% of debt collection calls are answered. And I think the number is less than 5% of those calls establish right party contact, meaning you're not reaching the person you want to reach. And increasingly, people expect to be reached digitally, right? You can screen all your calls or not have your phone even ring for calls that are from numbers you don't know. Very few people increasingly have a house phone anymore. Primarily, people are communicating by text and email. A lot of credit unions and other financial institutions have not made major investments to do that at scale in terms of texting and emailing it, and certainly not leveraging it for collections. And so there is a cost that they've not yet undertaken. And then there's also kind of a fear, right? I think particularly when you think about texting someone debt collection has a lot of rules and regulations about timing, time of day, and is often very fraught with litigation because people are fearful that you're going to sue them. So they want to preemptively come after you. So it's an industry where it's on the precipice of change, but it hasn't really yet changed. And then the consumer mindset is quite different also. It used to be that, pressuring someone and making them feel bad about owing an obligation was a great approach. I think increasingly, particularly with the younger generation, that sort of approach does not work, right? And I think we're having a better understanding about the intersection between psychology and behavioral psychology and how that impacts what people do. We also have social media that tells people how to avoid their debt or to run to bankruptcy attorneys or run to debt settlement. So there's also a lot more competing information, and people know, or whether it's the right or wrong information, of other alternatives for dealing with their debt that are not necessarily beneficial to financial institutions that are trying to collect. And so, we've come up with a different approach because we believe that financial wellness is actually at the core of the problem that member is experiencing. And if you can create a collections process by which you're not only, yes, collecting a payment, but actually helping your member rebuild their credit and access tools to rebuild their finances, at the end of the process, not only will you have a member who is potentially better off financially, but also more loyal, and you can retain them going forward because at their worst time, you were there for them.
How many credit union clients do you have?
So we have a couple right now, and we're in the process of, we expect to be signing a lot more in the next couple of months. And we've only been in the market a little more than a year.
And what's your fee structure?
We have for early stage. So there are organizations who have expressed to us interest for early stage, and that would be less than 90 days. So in the early stage, less than 90 days, it's a setup fee and a monthly fee. And there's no percentage of collections because earlier stage is highly likely to be paid. And we think it's just easier. It allows smaller organizations to be able to use us that haven't invested in tech and be able to have a collections operation that works for them. That's actually even less expensive, didn't even say a part-time employee. So that's for the early stage. For late stage, it's a combination. Sometimes it's purely contingency. So a percentage of collections that depends on volume, of course, and stage of debt. And then sometimes it's a blend of a setup fee and a monthly fee with some percentage of collections.
What do you see as your target audience in terms of the size of the credit unions?
There's two things I would say. So when it comes to early stage, smaller credit unions, and one of the things that I expressed to WSCU when Washington Financial, when I was establishing the QSO, was solving the problems for smaller credit unions is really important. So it's really our goal to serve that 20% of those that we serve are smaller credit unions. Kind of going back to my original, why you reached out to me, my article about outsourcing, I really feel like we can actually create I would love for us to be the QSO that all small credit unions could leverage for their collections, starting as few days. I mean, some people want to start as few as like four days late onward, right? So that we can really prevent people from getting later stages and keep the lines of communication open and be more in touch with members in a way that they wouldn't have the capacity to do on their own. When it comes to later stage, mid to larger size credit unions, of course, because they have more volume overall, right? And typically have much higher levels of delinquency to pass on to us. So we're lucky because I think because of the way our we're very much kind of automated, so to speak, in terms of these journeys that we send people through, that we are able to communicate with them, like you know, 6 days a week without someone having to be calling them all 6 days a week, right? Allows us to scale exponentially through software in a way that, a call center clearly cannot. So it's not a disadvantage to work with smaller credit unions like it might be with other kinds of startups that always try to focus on the larger credit unions.
Yeah, two things I can comment on are some years ago, probably about 5 years ago, the college I went to, I'd been doing some alumni fundraising, people in my own class, that sort of thing. And that year they said, don't call anybody unless you personally know them and they know you, because no one answers the phone anymore. Don't waste your time. Send email messages. Here's a list of email addresses. Use them. And I said, wow, because I don't answer the phone if I don't know who's calling.
Right.
Okay, yeah, we're all on board here. The other thing I think and about collections is if I'm working in a small credit union and you're my boss and you come up to me and say, hey, I need you to make some collection calls today. I'd say, I ain't making them. I ain't making them. Ain't gonna happen. You don't fire me. I ain't making them.
Yeah.
I mean, why don't I just call people up and say, call me stupid, ugly, curse at me for 2 minutes and hang up? I don't need that abuse. Ain't gonna do it. But therefore, if my boss says, we're outsourcing all of this to somebody, I say, hallelujah. Whereas typically the employee's scared, you're taking that. No, I'd say, take that work, take it all.
Yeah, I mean, and it's hard because it's funny because early on, before we're in the market, I started, do a lot of research, started joining the various, trade associations related to collections, and you'd sit in these calls and people would be like, oh yeah, at least once a week, a collector's talking to you says they want to kill themselves. And then this always happens. And I'm like, why? And I remember thinking, why would I want to be part of an industry or part of a process where unfortunately people feel the need to express that they want to die to you? Like, it's just
so they want to kill you.
Right? Well, they do want to do that as well. But
there's a lot of lethality happening here. It's a two-way street.
No, it's to your point. So there's a newsletter that comes out called CU Repossession. It's like this, obviously it's the repo guys. And I'm not kidding. Like every week someone gets shot repoing a car. Who would want to repo a car? Like it's so dangerous. I remember learning of a company that does door knocks. And what they do is they knock on the door of someone's home. And then if they get you home, then they put you on the phone with the credit union or whatever. And I'm like, who does that? Like, I would be afraid to door knock on anyone's home when I'm asking for money, essentially. Like, it's super crazy. But, I get that because people don't answer the phone and all that sort of stuff, that there might be some sort of desire to figure out other ways to reach people. And there are credit unions that do the door knock visit thing. So I actually did a demo for one a couple of weeks ago. And I was like, wow, that's wild that you will send people to someone's house. I think that like you couldn't pay me any amount of money because in today's world, people shoot first and ask questions later. So see these like constant like assaulted, shot, whatever. because people will say, well, I didn't know that you were a repo person. Right?
Exactly. This car thief. I'm just trying to get my damn car back.
Right.
Uh, so your business primarily is using computers to communicate with debtors, right?
Well, telecom communications, right? So like SMS, email, voicemail, job. We do calls and we have AI agents for that as well. We do have a
Oh,
person.
cool.
And I mean, it's interesting because it used to be that, I mean, what people don't like is those IVR systems where you press one to talk to someone, press two, say what you want. People hate those,
Right.
but like actually talking to an AI, people don't mind anymore. I mean, now with the explosion of like ChatGPT, people are used to and kind of acclimated with the concept of
Right.
interacting with AI. In fact, they would much rather interact with AI than an actual person. What we find, for example, just through, because what we do is we have an omnichannel platform that's self-cure. So the member can actually go online and resolve debt on their own terms without having to talk to a human. What's unique about our platform is that we don't do any preset repayment plans. So we work with the credit union. We say, what's the minimum payment? And this is usually at like a charge off, of course. So late stage, you're not getting anything from them anyway. What's the minimum payment you'll take? Sometimes it's $10 or $25. People can pay weekly, bi-weekly, or monthly, which is unheard of. And in fact, one of our credit union partners, the reason they were excited to work with us is because their base of members are grocery workers that are paid on a weekly basis. And so having weekly payments makes a lot of sense, right? There's a lot of great alignment when you can align when you get paid with when a loan is due. And so we have that. And then so weekly, bi-weekly, and monthly, they can pay with Venmo, PayPal, debit, and bank. By far and away, debit and PayPal are the most popular payment types. One of the reasons we offered it in the first place is because I had read that on average, Americans keep about $216 in these peer-to-peer payments accounts. And so for the cost of going to dinner or whatever, they can get started or actually start paying their debts. And so we found that to be very much the truth. Also with debit cards, maybe you get a debit card for Christmas or for some other time of year, and you could use that money to pay your debt. Why wouldn't you? We also have baked into the product, like you can reschedule your payment plan at any single time. If you're having a hardship, you can indicate a hardship to pause collections. We even have the capability for you to do a settlement. Like I would say, you just got your tax return and you want to do a one and done payment. You don't want to do the full amount. So therefore, you offer a lesser amount. We have that built in. So the settlement authority, based on what the credit union is willing to accept, is what we put in there. The person puts in a number. It gets accepted if it's above the settlement authority. If it's below, then they're told the minimum they must pay. But it allows them to handle that process. It's typically like if you're in collections and you're trying to settle your debt, it's a haggling. Sometimes the collector knows what the minimum is that they can take. Often they don't know, especially because you give a number, they have to check with somebody. So this takes away that sort of friction. We also have a credit builder embedded in our product because once your account has been closed, repaying that debt doesn't rebuild your credit score. And this is actually one of the biggest issues around disincentive for fully repaying debt because your credit's been ruined, right? Your credit's already been ruined and you have a lot of debts to pay. Why would you fully repay your debt if you're actually not going to rebuild your credit? Like if you can pay a lesser amount, of course you would, right? Because by and large, there isn't a huge advantage other than, if you're being forgiven a large amount of debt, in which case you would be issued a 1099-C because that's considered taxable income. But other than that scenario, a lot of people would rather be able to rebuild their credit. So they often focus on credit repair, which has become which is a very scammy industry. And it's now a $4.5 billion industry where people are paying these third parties to try to rebuild their credit because of these sort of damage mistakes. So by having a credit builder embedded, it provides an incentive to actually start repaying because they can actually start rebuilding, but also an incentive to keep people on their payment plan because there is some sort of benefit that they're deriving from the newly reported trade line. And then I think I also mentioned we have personal financial management tools where people can create budgets, they can set alerts, they can make debt repayment plans. Like we have this tool tracker where you can pick snowball or avalanche method and like attach all of your banking accounts. It can generate a budget for you, or you can do it yourself and actually help you figure out how you allocate getting out of your debts. It's really a kind of an end-to-end tool to help people repay and rebuild for those people that really want to get forward. and they don't have to interact with a person if they don't want to.
What percentage of debt is charged off?
Overall, in terms of, let's see, it's pretty high. So usually it's around for, and in good times it's less than 1%. In bad times it's anywhere from 1 to 3%. Unless you're a subprime lender, you can be much higher. But for credit unions, they tend to have overall lower levels of delinquencies. What tends to be more challenging for credit unions are indirect loans. So loans that people got through a car dealership where they didn't have a direct relationship, right, with the credit union. Those loans have a higher rate of default than other kinds of loans. Of course, then there's other factors in general, like right now, auto loans, because of the price of cars has gone so high, the price of insurance has gone so high. So there's a lot more in general, either self repos where people are returning their cars back to their credit union and they can't afford to pay them, which in those instances net something called an auto deficiency, where the credit union say you bring your car back with the keys, they sell your car, but the problem is the value that they are able to capture is there's usually a balance difference between what's still owed on the loan and what they got from selling it. And so a lot of people still owe that balance, which is called an auto deficiency. So that space right now has been a very large space. Mortgages are starting to tick up quite a bit too. And then credit cards have been problematic for a while, and still are. People are also starting to see some upticks in HELOCs also going delinquent. But, delinquencies are kind of cyclical with the economy, right? But at this point, while people say, oh, delinquencies have normalized, post the pandemic, the reality is they're still the highest they've been since the Great Recession. So they're not as high as the Great Recession, but they are higher than normal.
When you are talking with a credit union, how do you sell them on your service?
Well, we talk about the whole idea of like the notion of being able to serve and reach members where they are, right? Because that's what we're doing with the communication tools. We find, for example, text messaging is by far the most effective way to reach people. We get a lot more information from people. And then the 1-2 punch of our ability to basically be in touch with your member almost every day is something that's not going to happen with calling, right? You can leave lots of messages, but you don't actually touch base. We actually see the engagement, them opening the text messages, opening the emails. So one is that we're able to be more consistently and engage with your member, but also doing it in a way that upholds the credit union's values. Our communications, particularly our texting and our emails, are not just simply pay your debt now. It's full of financial literacy, personalization, and psychology, and really trying to like illuminate for people, why paying their debt matters, and really trying to look at what is it that you want. I mean, nobody likes to be in debt, but typically when people are on the path and decide they want to get out of debt, it's usually for a reason. They want to buy a house, they want to move out of their parents' basement, they want to go to a next stage in their life in some sort. And so really it's kind of tapping into how you can help empower people to kind of get on that path and deal with their debt and get out of it. So our value proposition, in addition to like helping get recoveries from people who might not otherwise be responsive, particularly in a phone-driven process, but also you can create greater loyalty and retention, right? Because after that process, those members who you thought were lost can actually be retained. And we can actually say, oh, Susie, she's actually grown her credit quite a bit. And, you might want to think about reaching back out to Susie for her next loan products, right? Or to reopen an account with you. So that's the other thing, because we're really focused very much on that notion of creating the win-win, both in better financial health for your member, but also the retention opportunity.
It's interesting. The debt collection industry has a bad reputation in general.
Yes. I actually said, it's funny because I was debt.org loves to like do these interviews, like they're doing like social media kind of clips. I did this clip talking about how, the only other profession I think hated more than debt collectors are parking enforcement officers, right? Right? Because everyone hates when you walk out of like being somewhere and you find a ticket on your car, person writing the ticket as they're coming, right? And when that meter maid person doesn't stop the ticket, right? When they continue to write it and won't give you any grace is what makes you angry and enraged. And I think that's what makes people most upset about debt collection, is that there is you feel like there's no grace. You're having a tough time. And the collector's job, many of them are, commission based, particularly in agencies, both from sometimes it's a daily commission like threshold they have to meet or a weekly threshold they have to meet. And so their goal is to get you to pay something, often by scaring you, right? Often by making you feel bad, not by because they don't really have other levers, right? That's for them to create the sense of urgency. So debt collection, it has a lot of regulations also as a consequence of the abuses that have happened where, collectors are essentially salespeople. You think about salespeople, how often they call you. I mean, nonstop and emails and the calls. Like, imagine if you owe money and they're like, it's even worse. Starting out, we actually bought some debt because we wanted to see, before we got into the market, we felt like people would trust us if we had done it before. We really wanted to understand what that was. What was shocking is, yes, you could buy debt for a penny and a half on the dollar. You can buy it
That's
for less.
mainly timed out debt, right?
Yeah. Well, it's not timed out debt, it's just delinquency. So these debts were under the statute of limitations, and it was still a cent and a half. They were loans. The thing that we didn't know when we first bought the debt, like we thought we'd asked all the right questions, and there were a couple different things that, you're an early stage startup, you're working with a big credit bureau that's supposed to be providing data for you that, of course, you're not really their priority. So what should take a week takes a couple of months. Then you ultimately, we move fast. You're trying to figure out, okay, should I just go ahead and take this debt in? And like, what's the worst case scenario? We're not paying that much money for it. But, what we discovered was the debt was 465% interest rate. There's a direct correlation between interest rate and willingness to repay. And I understand that. At the time when your car broke down and you really needed $1,000 so that you could fix your car and get to work and not miss those shifts, you'll take whomever will lend to you is what you will take, right? And unfortunately nowadays with the proliferation of online lenders, you basically can get a loan within hours, like wired into your bank account the same day that you need that money. And those sort of lenders really prey on people by offering like super high predatory interest rates because they know you're desperate. But of course, that means that those people at the moment that they need the loans, of course, they agree to it. But after a while, after they've realized, gosh, I borrowed $1,000, I've already paid $2,000. How much more should I keep paying? Of course, they start to default. So debt buying is is a large industry. There are some credit unions and other financial institutions who like and prefer to sell their debt. And partially because there is a lot of reputational damage to holding on to the debt, like doing the later stage collections, or if you're choosing a litigation strategy, right? Like most debt buyers who do late stage debt, not timed out, but before timed out debt, like so because the statute of limitations varies from some are like as long as 10 years, some as short as 4 years, but most of them buy, the debt that's a few years old, but before the statute of limitations, because they are willing to and have an aggressive litigation strategy. Some of the largest players in the space, the publicly traded companies in the space, have actually bragged on quarterly earnings calls about their litigation approach being so successful for them in recovering from people, which is actually kind of depressing, right? Actually, I had a credit union that I thought was going to close, and they're like, "Oh, well, you guys don't do litigation, and we want to do litigation." And I said, you know, I'm personally against it, and I personally believe that our whole process is to help people avoid getting to litigation by creating a way that they can engage that is lower stakes than the existing system. Quite frankly, if you have to like garnish someone's wages to get them to pay you, I don't know how you feel good about that personally, right? Because that's all that happens there. People's wages are garnished, and some states have had to change the amount that you can garnish because it's a huge imposition. Like, in fact, I think one of the reasons that the administration decided not to initially was saying they were aggressively going to go after student loan defaults, and then decided not to, was everyone's talking about the cost of living and prices and the economy and all that sort of stuff, and people not feeling happy about it. And if you start garnishing people's wages, it impacts their ability to pay their other obligations.
You touched on this earlier. The sad part about this is that if you have enough bad debt, your credit's going to be screwed up for perhaps 7 years. And that's just reality.
Yeah.
Even if you win the lottery today and you pay off all that debt, you even pay a little extra because you're feeling kind. Your credit is still screwed for 7 years.
Yeah, and over time, the more, I mean, there's two factors. Yes, so for 7 years, your credit score is immensely the further that you get from the delinquency, right? So like at year 3 or 4, if now you have everything, you know, on time, like now you have everything, you're paying it on time. But the thing that has to happen is that you also need to acquire new credit, right? Because the only way to build credit is with credit. And the hardest thing to get when you have bad credit is credit, right? And so the typical thing that happens to a lot of people, the first thing that happens when you fall behind and then you start to look slightly better or time is moving on, the first group of creditors that reach out to you are those super predatory, high interest rate, high fee, no rewards credit providers that come your way, and you're desperate to build credit, so of course you choose them. But like if you have a credit card with a $300 credit limit and they charge you an annual fee and a setup fee, and so then you always have high utilization, its ability to build your credit isn't as strong, right? Because if you have a $300 credit limit, it's not surprising that you might be using most of $300, but utilization is like 30% of your credit score, so you don't want to be doing that. It is really interesting because yes, the 7 years matters generally, but what helps you is if you can start getting new products and establishing positive payment history, then it might only be 4 years before you can actually start being able to qualify for a mortgage or a car or something. Of course, the interest rate will make a difference. Like I think one of the things that was shocking to me to learn was that you can get a car loan with a 29% interest rate. Now, of course, they've projected that most half of those loans will default, but it just blows my mind that someone would pay 29% interest rate for a car. But that's what someone will give them. And that's the thing I find actually frustrating about some of the online lenders that say, "Whoa, we give opportunities to people that no one else would lend to."
That would screw them.
Right. But at a very high interest rate. And those products typically are not, they're shorter term in length, so they're not even credit building. So you're loaning people money at a really high rate, claiming to be doing them a favor, but also doing it in a way that doesn't even build their credit. Like there's like, but if they screw up, you will report it to the credit bureaus, right? So you will ruin their credit if they fall behind, but you didn't build their credit when they were
Right.
paid.
I just was thinking of, I called up credit unions that I know reasonably well and said, "Hey, I want to talk to you about your AI strategy." Most of them would say, "Okay." "I want to talk to you about your Bitcoin strategy, or actually your stablecoin strategy." Some of them would say, "Fine." If I said, "I want to talk to you about your debt collection strategy," they'd all say, "Nope." I think every single one would say, "Nope." Ain't got no comment on that.
Well, it's interesting because it's again it's this industry that's at an inflection point, right? Because still hardliners that have been involved in the industry for a long time are very much wedded to no, we want to be calling people, we know our members, that's going to be the best approach. But they're also running up against the fact that like it's less and less effective and you have to deploy more people to do that. And the reality is that you do need to transition to a more digital approach, but a lot of credit unions don't have a really solid digital outreach strategy. Even some mid-sized like credit unions that are in the several billion dollars don't have like something as simple as a monthly newsletter, right? Which is kind of strange to me. You know, I was talking to a large credit union that said that the number one reason that people called their like member solutions is to figure out how they can make an online payment. And I just thought, what a huge disconnect, right? That there's thousands of hours are spent so someone can ask a question because sadly, I think the challenge for so many credit unions websites is that there's too many things on the front page, right?
Yeah.
And so, and people are lazy, right? We live in a world where everyone's very much focused on convenience. So if I can't ask an AI agent or, really quick or a Siri or whatever, or go right to your website and simply see what I need, then I'm going to go do the next best, fastest thing when I perceive the next best, fastest thing to do. And if I know there are people at my credit union that will actually answer the phone, then I'll call them. Then to go online. But yeah, so I do think that the digital transition, a lot of credit unions have not made it yet. And I think that's the challenge around collections more generally. There is also this bias towards we know our members and like somehow feeling like digital outreach is impersonal, even though that's how we all communicate these days. So I do think that is changing. I started a podcast actually about collections, with interviewing collections professionals, and it's actually encouraging to hear things that people are doing to really, whether it's machine learning or AI, default prediction. People are starting to look at that. People are really looking at how who to target, like who to like reach out to more often and has capacity. I think in general, not just credit unions specifically, but all financial institutions have a gold mine of information, but don't leverage or use it. I mean, even though very large banks will be honest and tell you they don't leverage or use it. Like I asked the head of collections and recovery at one of the top three banks if they were using any sort of AI, and they're like, "Oh, well, we've had so many issues with regulators, like, and we don't know anything about our people who are like severely delinquent and charge off, and because of disparate impacts, and we don't want to be accused of discriminating against certain people or whatever, we just don't know anything and don't even look," which is crazy, right? Because sometimes someone will have a business loan over here and an auto loan over there, but that's not the way that the books and the systems are set up. That's not unified, so they don't have that unified view, which is kind of crazy to me, but that's often what happens. So I think, collections, part of it's been like legacy systems, of course, within credit unions and other banking institutions have not been great, and sometimes information isn't in one easy place to get. I think that's been one of the reasons why, like, leveraging AI and collections and machine learning hasn't always been a thing. But I do see a lot more organizations leaning in that direction. Of course, those are the larger organizations, usually those who have like 100 million a year in like charge-offs. It's not as much around somebody, a credit union of 100 million in assets. They're probably not going to be able to leverage that because they would need somebody to be able to do something with that. In fact, I have a friend who has an AI company, and I'm not going to say the company, and she was working with a CFO, and she's like, "Listen, hey, I can actually do default prediction for you to tell you who's going to default." And so she did the analysis, and you could hear your members that are going to default. And she said the CFO said to her, "Well, what am I supposed to do with that information?" And I thought about it, and I'm like, well, in the context of a credit union, who would be in charge of that, right? Because collections is only reaching out once you've defaulted. And member solutions is really about selling new products or like answering general questions, but like there's not really a place, right, theoretically, where the people who are defaulting potentially will default, right, haven't yet defaulted, who would be in charge of dealing with that. That's it, and then that becomes a reason why people don't do it, right? Because no one has figured out who would own that, right? Because again, it's not collections because the person hasn't fallen behind. If I haven't fallen behind and you're calling me for collections, I'm going to be annoyed. Similarly, one of the things that annoys people is that like if your mortgage is due on the 10th and you always pay on the 8th, why am I being called if I haven't paid on the 5th? Because I always pay on the 8th, and you should know that I always pay on the 8th and be tracking that information, and that really frustrates people when their behavior is consistent, but their financial institution doesn't know it, right? Yeah, so collections is interesting because I do think that there's evolving opportunity there. I do think that, again, this is probably why outsourcing will be better, because the way things are structured within a credit union or any financial institution means that like when you have a gray area and a new discovery path that AI might bring for you, who do you assign it to? Do you need to hire more staff? What do they need to know and learn? And that makes it more complicated, which is why I think outsourcing can be very, very beneficial. I mean, we've said we'd like to be that partner, right, on the default prediction side, so that we can say what you would do is you would target those members with communications, letting them know that there is a skip a pay or how they could modify a loan or whatever it might be. And we found it very interesting that sometimes in our collections process, we've had members that come back to us and they're like, "Oh, can you refinance our loan for us?" And we're like, we're not a lender. We can't do that. You have to go back to your credit union. But that's the kind of flexibility that people want. And so I think things will start to evolve and collections will actually get better in the future, because I think people are need more flexibility. And I think the status quo of how we've done things isn't going to work. And I think if you look at a product like Buy Now, Pay Later, where it's more payments over more time, over time, might just say that the traditional structure of a once monthly payment may not be the best approach going forward in the future. And if that is the case, then collections needs to evolve to that.
Now, I hear from people that some institutions are saying that they're seeing a different morality in their consumers. More specifically, they're seeing people dispute charges that really the consumer made the charge. They're just lying.
That has become, and that area is particularly bad among younger consumers.
Yeah.
The statistics are really pretty
the
high.
people, the restaurants, you go out on a date Friday night, it's a bad date. You pay $120. As soon as you get the bill, you say, I didn't go to that restaurant. It's a crappy restaurant. Why would I go there? I kind of understand that, but it's not a moral thing to do.
No, and I think increasingly, I mean, what has kind of accelerated that is that for a long time, credit card companies and a lot of businesses will take your word at it and just reship the new item, right? And so obviously that makes everything more expensive. And I don't think people understand that. A lot of people think, oh, it's a big company. It doesn't really matter. Like, why do I care? That happens a lot with Amazon. Like people say they didn't get an Amazon package they actually got. The surveys on the high number of Gen Zs and others, like more than 50% have admitted to doing that. It's pretty high.
Wow.
And it's because either the person, the organization fulfilling, or the credit card companies, right? Which started with basically making it fairly easy for you to do chargebacks, especially in a world where there's not a wet signature anymore. No one's even comparing the signature anymore, right? It's the pin and chip, not the chip. We're not doing the pin part, but the chip was supposed to change that, right? In terms of the liability, because initially it was that if you disputed a charge, it always was basically the credit card scheme would take that on as the liability, but then after the law changed in, I don't know, 2015, I think it was, that if you were the merchant and you didn't use the chip, right, once the chip came live, then you would be liable if the person said that they didn't make the charge, right? So, but by and large, the consumer has found it fairly easy to dispute charges for things. And that's where we have a challenge. And then in the delivery space, in the like online, purchase space, it's a huge problem because so many people lie about not receiving packages that they've actually received. And I have a friend who is a startup founder, is a small beauty company, and she's had that happen, and she's found it very frustrating, right? Because people say, "Oh, I didn't get that lipstick," and they absolutely did.
It also impacts debt collection.
Yeah. Oh, absolutely.
If you're going to lie about whether you got a package or not, you're going to lie about all kinds of things. And what the hell if you default on this damn MasterCard bill? Big deal.
I mean, a lot of people
entered a slippery slope of ethical decision making.
I mean, what's interesting, so what's fascinating, obviously, with a lot of the online lenders now, they're actually, because, people will dispute a debt and then we will provide the documentation and it'll actually have the IP address by which they signed, right? The lending product. So when we found that people have disputed debt, we more often have been able to show them that, well, here's what you signed. Then they have to make a decision. But we haven't seen a huge amount of disputes at the level. I would say the largest amount of disputes we ever saw was with that high interest rate loan, the loans that we bought.
Yeah, no, that makes sense. Probably someone's told them that interest rate is illegal. You don't have to pay it. Just
and I think what happened in that instance, what I discovered is that there are usury laws in most states, and those usury laws generally impact payday loans, which are much smaller loans, or much larger loans. And so there tends to be a gap of loans that fall sometime between the $1,000 and $2,000 or $2,500 range that those laws miss. And they can have these really crazy interest rates. Like someone posted on Reddit not long ago, a loan with a 965% interest rate. And they wouldn't offer it if nobody bought it, right? So,
well, as you said some time ago, in a moment of desperation, people will take whatever they can grab, and then they deal with the consequences later. Or
100%.
in some cases, they choose not to deal with the consequences and just try to ignore them.
I think the other part of it is when you think about money is a weird topic. We are all told not to talk about money, but that only seems to advantage people who have money. People who don't have money, not talking about money means that people have a lot of myths and misconceptions and they don't get good advice. Gen Z and millennials get 80% of their information about finances from social media, which is shockingly scary and horrible, but it's just true. And so because of that, I think when somebody is in dire need for money on a short term, the stress and thought of asking a friend or someone that they know for the money, it's tough, right? So if I can go online and this lender, even if the loan price is super high, is willing to give me a loan, I don't have to have an uncomfortable conversation with a family member. And if God forbid that I don't ever want to pay, I can't pay them back, I don't have to ruin a relationship. So that is part of the other part of it is just sort of when people are in dire straits, they feel ashamed to talk to someone that they know about it.
Before we go, think hard about how you can help support this podcast so we can do more interviews with more thoughtful leaders in the credit union world. What we're trying to figure out here in these podcasts is what's next for credit unions. What can they do to really, really, really make a difference in the financial scene? Can't all be mega banks, can it? It's my hope it won't all be mega banks. It'll always be a place for credit unions. That's what we're discussing here. So figure out how you can help. Get in touch with me. This is rjmcgarvey@gmail.com. Robert McGarvey again. That's rjmcgarvey@gmail.com. Get in touch. We'll figure out a way that you can help. We need your support. We want your support. We thank you for your support. The CU 2.0 podcast.